everyone, welcome back to Mike and his whiteboard. My name is Mike. This is my whiteboard. Hopefully everyone had a great weekend. We're going to start off the week today with a concept called drag. So when we're talking about drag, we're actually talking about certain products that are comprised of balancing futures instead of physical products or stock. So when I talk about drag, we're talking about things like, an example would be USO. So USO is basically an ETF that is comprised of constantly rebalancing futures of the crude oil CL. So what we're looking at is the difference between the two contracts and what would comprise that of contango and backwardation. So we're going to get into all these terms here. It's a lot more simple than you think, so we're going to get right into it. So when we're talking about drag, what can result is an underperformance due to portfolio rebalancing with futures. So it's not always the case, but when we talk about comparing a product that has physical attributes to a product that is comprised of rebalancing futures in a portfolio, when there's drag or when the futures are in contango, it can create a drag. So what contango essentially means is when you look at the actual future that the portfolio is made up of, when the front month is trading for less than the back month, so one quick example would be like if November was trading for less than December, that futures product would be considered to be contango. So the flip side of that is called backwardation. So when the front month, so if November was trading for more than the back month, December, that would be considered backwardation. And when a portfolio is constantly rebalanced with these futures, it can create a drag or a positive drift in backwardation here. So we're going to break down some examples on the next few slides here to make it real easy for everyone. So looking at drag and contango, when we're talking about futures, we're going to be looking at November and going into December. So I want you to focus on the size of these futures contracts here. So November is smaller and December is larger. So basically when we're constantly rebalancing, one thing I want to point out is that these portfolios are not entirely made up of just 1 month. So there's going to be a portfolio balance between November and December. But if November is trading for less than December, it's going to create a negative drag when that portfolio is constantly rebalanced. And if we go to the next slide here, we're going to break it down with some numbers. So when we're talking about contango, let's say that a futures contract was trading for $14.75 in November and $1,500 in December. So let's say I've got 100 contracts of the November futures, and I need to roll that into December futures. So again, that's not really how it's going to work in the real world, but for simplification, we're going to use that as an example. So let's say I've got $147,500 worth of futures in November, and I need to roll that into December. If I have 100 shares of, or 100 contracts of the November futures contract, and it's only worth $147,500 if I have 100 contracts of these, and I need to purchase these Decembers that are trading for $1,500, or if I multiply that by 100, it's going to be $150,000. There's going to be a deficit here. So I'm not going to be able to roll 100 contracts in November into 100 contracts in December because December is trading for a higher price. So now instead of 100 going into 100, it might be selling 100 November contracts and only being able to buy 95 or 96 contracts in December. So because of that imbalance there, it's going to create a drag. And as you see here, there's a $25 difference between the November contracts and the December contracts that are trading for a higher premium. So because of this, it's going to create a negative drag because like I just said, we can't take these 100 contracts and translate it exactly into 100 contracts in December. We don't have enough capital to do so. So because of that, I now have a drag on my performance. So if the futures contract, for example, goes up 1 point and I had 100 contracts here, I'm no longer reaping the benefits of 100 contracts if I roll it into December. Like I said, if I can only purchase 95 or 96 futures contracts in December, it's no longer 100 for 100 or 1 for 1. It's going to be 1 to 0.96. So it creates that drag, and it basically creates an underperformance when we compare it to other products that aren't made up of these constantly rebalanced futures. So on the flip side, we're going to talk about backwardation and situations where that might occur. So if we go to the next slide here, when we're in backwardation, it's just the opposite. So if I'm looking at a November futures contract, I would expect to see it trading for more than the December contract. And this is actually a pretty rare situation. Normally futures are going to be in contango, which you might expect. When something has more time value to it, it should be trading for more. So when we're looking at contango, you'll normally see regular products that are trying to track futures products in a normal way be in a contango state more often than a backwardation state. However, this does happen from time to time. So when a futures contract or a futures portfolio, such as we're looking at USO, which is based up of rebalancing of futures, if it is in backwardation, a daily rebalancing would result in a positive drift or an outperformance of that actual raw future. And it's just because of that same example we gave before, but the opposite. So if we go to the next slide here, we'll break it down with some numbers. So let's say November was trading for 1,500, and let's say again I've got 100 contracts in my portfolio for November, and I need to roll that into December. So if I've got 100 contracts, I've essentially got $150,000 worth of contracts. If I sell those in the November, convert that to cash, 150,000, and I need to now buy 100 contracts in December, I actually will have a surplus of $2,500. So we've got $147,500 here, and we sold it for $150,000 over here. So because I have that surplus, I might be able to sell these contracts here and buy a little bit more in December. So now if the underlying actually does go up, I'm going to have more of an effect when I roll it into December because I'm going to be able to have more contracts in that portfolio. So when a futures portfolio is in backwardation, if I have a situation in, like, for example, USO, which tracks the movement of CL, if that CL underlying does actually go up when we're in backwardation, I should see an outperformance in USO compared to CL because of this exact state here. So there's a difference between the backwardation and contango, and we're going to wrap it up here with just some takeaways to wrap everything together. So if we go to the next slide here, we will talk about the takeaways here, but actually first we're going to talk about some examples for contango and backwardation. So when we're looking at things that are normally in contango, you might see some examples like VXX, USO, and UNG. So USO, we just talked about, sort of tracks the futures contracts, where VXX tracks volatility. So volatility is going to be based on the /VX volatility future contract. And something that you might normally see in backwardation would be XIV, which is essentially the opposite of what this tracks. So it's just looking at the opposite. So if this is normally in contango, you might see something like XIV normally in backwardation. So really it just makes a big difference when we understand what we're trading to better our knowledge and understand what's actually going on here. So now let's get to the takeaways and we will wrap it all together. So drag and drift are a result of leveraged ETFs and ETFs that are not comprised of physical assets. So if we look at something like GLD or SLV, for example, those are actually comprised of physical gold and silver products. So you won't see that same drag as we do in something like USO, because USO is constantly rebalancing futures as opposed to actually owning those oil barrels. Also, contango is when the front month is trading for less than the back month. So again, as an example, if I'm looking at November and it's trading for less than December, that would be in a state of contango. And if I'm looking at a future where the front month is trading for more than the back month, so if November is trading for more than December, then that futures product would be in a state of backwardation. And again, understanding what we're trading will aid us in the long run. So I think the big takeaway here is that there's going to be a drag associated with products that are trying to balance their replication off of futures. So when we're looking at futures, there's a cost of doing business. So if I'm rolling from November to December and it's in contango, I'm going to have to sell my November position and buy the December position, and that's going to cost me something. So it's going to be very apparent if I'm just trading futures, and I'm going to understand that cost of doing business because I'm the actual one that's making that transaction. But with something like USO, it's really easy to misunderstand the product if we're not totally sure of what's actually going on under the hood, because really with USO, I can just buy the shares and let it sit there. But I wouldn't know that it's underperforming if I don't actually dig into the product and understand what it's comprised of. So understanding what we're trading is going to be very crucial going going forward, just understanding that pretty much any product that is based on leveraging something against something else, or replicating a futures product based on a portfolio made up of futures rebalancing is going to have that drag and drift. And one last thing I'd like to point out is that when we're talking about contango and backwardation, products aren't always in contango and products aren't always in backwardation. There's some products that are normally in contango and normally in backwardation, but those can change. So something can go from contango to backwardation and from backwardation to contango. So it's just really important to understand where the product is that we're trying to replicate. So for example, USO, if I wanted to trade USO, I might actually look at /CL first to see if it's in contango or backwardation, so I can have a firm understanding of the product that I'm actually trading, which is USO. And also because of that drag that it seems to have, USO might not be the best long-term investment for what I'm trying to do. So maybe instead of looking at USO, I might look at something like OIH, which is oil services, and that's something that's actually not based on the compromisation of the futures and the front month and back month totally rebalancing. So that might be something that I can get my hands into oil but not have this drag associated with it. So hopefully you enjoyed this segment. Hopefully we broke it down for you. My name is Mike. If you've got any questions at all, shoot it over to support@dough.com, or you can tweet us at @DoughTrading, @DoughTraderMike, or we'll actually be off tomorrow for Truth or Skepticism, but we'll be back on Thursday at 3:15 p.m., so we'll see you then.
Hey guys, I hope you enjoyed this video.
Click below to watch more videos, subscribe to our channel, and if you want to trade along with us, visit